Welcome in PharmD Nation to PharmD 360, your 360-degree view of everything that's going on in the world of finance this month. I'd like to start off with the hot topic that I know is at the top of everybody's mind, and that is inflation and what it is doing to our investment markets currently. So everybody listening is probably aware that inflation is basically the percentage increase in all the goods and services you have used compared to a previous point in time. Everything, because of inflation, is getting more expensive, and it's getting more expensive rapidly recently. Now, a lot of people ask, where did inflation come from? What's the primary cause? And although it's very, very hard to nail down what the primary cause of inflation is, there are a lot of things that have happened recently that I think have caused the rampant rise in inflation. The number one reason being the increase in the money supply in America. Over the last 2 years, the money supply in America has increased by 43%. And just think about that. That just makes sense as a reason for why inflation has run rampant recently and why I think it will continue to stay higher than what people had hoped for the foreseeable future. If you dump more money into our economy, it means there are more dollars chasing more or the same number of goods and services that people buy in our economy. So more money means more competition for those same fixed number of goods and services, meaning that those fixed number of goods and services can increase their prices because there are more people with more money going after those same things. So the recent expansion in our money supply is probably the primary reason why inflation is running so high right now. But the Federal Reserve is tasked with lowering inflation, and that could cause for a lot of other issues outside the inflation realm. One of the biggest areas we're seeing issues in right now due to inflation and the Federal Reserve's response to inflation is a really, really volatile stock market. The Federal Reserve will try to combat inflation by taking money out of our economy or restricting or tightening the money supply. And it's basically the opposite of what we talked about before. When you tighten the money supply, you basically are limiting the amount of money that is going after those fixed number of goods and services in our economy if we assume that growth is pretty flat. And when we restrict that money supply, less goods and services are going after those fixed number of or less money is going after those fixed number of goods and services, which means the price, hopefully in the future, will drop. And that's the primary way, and it's a simplified form of how the Federal Reserve can combat and try to bring inflation down. However, that plays a big role in how the stock market does historically. Because as the Federal Reserve tightens, interest rates usually go up, and when that happens, a lot of money will flow out of the stock market, and it'll find other places that are safer, that are paying a better fixed interest rates now that rates are starting to climb, usually. And a lot of the money that pulls out of the stock market is money that is more growth-oriented. Money that's probably sitting in stocks like your Tesla, Netflix, Apple, Microsoft, companies like that. So our economy goes through a transition where either money flows out of the stock market from those growth stocks, or money usually transitions from those growth stocks into more value-based stocks. And that's why recently we have seen a lot of those high-tech, high-growth, high-flying stocks that have had tremendous rates of return over the last 18 to 24 months drop dramatically in a matter of weeks. So that's a little bit about things that are going on in our economy that have to do with inflation and kind of the volatility, the increased volatility we've experienced in the stock market. And I think it's also important to note that volatility is actually normal. I think we as consumers need to reset our minds to really understand that volatility over the last 2 years has been very abnormal. It's been basically non-existent, specifically over the last 12 months. And although we probably have gotten used to that, we have to understand that volatility in the stock market is something that's normal. And seeing big pullbacks between 10, 15, 20% within a year is not that crazy when you look at the history of the stock market. So just know that volatility, as it comes back, it is normal. And really volatility, or people who can handle volatility, are the ones who are usually rewarded with higher stock returns and higher investment returns farther along in the future. Now, it's easy to say that when you're an accumulator, because as an accumulator, as you're saving, as you're continuously investing, it's actually a good thing for stock prices and investment prices to come down, because it gives you the opportunity to buy into those investments at cheaper prices. So when the all-time highs return again at some point in the future, whether that's right around the corner or years and years and years from now, the amount of units you own are bought on average at a lower price. So when they return back to their all-time highs, you're actually going to earn more on more investment units that you purchased at a lower price, meaning that your overall value inside your investment account could be a lot higher. For deaccumulators, which are the people that are approaching retirement, people that are in retirement, my hope is that you have some sort of deaccumulation strategy, some sort of withdrawal strategy that allows you to combat what's going on right now while not doing substantial harm to your retirement portfolio. And there are definitely ways and strategies you can put together for that if you haven't already. So as the economy gets crazier, as more volatility creeps in, because I imagine it will, and as we enter our next recession, whether that's this year, next year, or a couple years down the road, we don't know for sure, just be aware that what we're going to experience is nothing we haven't experienced before, and long-term mindsets and long-term investors usually win out in the end. Another big development that went into last year is the Build Back Better legislation never got passed, which means a lot of the very beneficial tax planning strategies that I know a lot of pharmacists use are still available to use up till now. I don't know what the future or the rest of the year is going to look like. And one of the big ones is a backdoor Roth IRA. It essentially is a way for people to be able to get money into their IRA without making normal contributions. And that happens when your income exceeds a specific limit. I think it's like $208,000 for a married couple this year. Just note that if you are thinking about doing a backdoor Roth conversion, if that's a strategy you think you want to implement this year, make sure you don't have other IRA accounts to your name out there already. If you do, you may run into the IRS pro rata rule, which could completely eliminate all the benefit of doing a backdoor Roth IRA conversion. So if you have other IRA assets out there already, there are ways to get around it, and there are things you can do, but just know doing a backdoor Roth conversion while you have IRA sitting out there is probably not in your best interest. But backdoor Roths are still available for us to do because the Build Back Better rules that were going to eliminate it never got passed, so we're good to go so far. And then finally, the last thing I wanted to touch on is, again, going back to the original point of what's going on in the stock market, what's going on in our economy. It's very, very important for everybody to think long term. We're going to experience things we probably haven't experienced in a while as far as volatility, investment pullback, and crazy swings, headlines, and different talking points that you're going to experience now for probably the next 24, 36, 48 months, maybe shorter, maybe longer, nobody knows for sure. But it's extremely important, PharmD Nation, that you keep a long-term investment mindset and you don't do anything crazy short-term that could hurt your long-term potential and your long-term goals. So that's what I have for you this month. This is PharmD 360. Until next time, be well, PharmD Nation.